Without further ado, let's start the webinar. For this session, we have Louis Wong, Director of Phillip Securities Hong Kong, covering the Hong Kong and China stock market outlook and his top stock picks for the third quarter of 2023. Let's welcome Louis.
Hi, everyone. Thank you. Good afternoon. It's me again. This is Louis Wong. I'm the Director of Phillip Capital Management Hong Kong. Today, I will share with you my third quarter strategy and stock picks and where are the rising stars in a declining market. Okay, these are the my key discussion points today. Go through with you review of China and Hong Kong stock market. What are the headwinds the Hong Kong stock market is currently facing? Overview of China's economy and 2023 outlook. And also people are concerned about the recent depreciation of the Chinese yuan. So I will also share with you my view on the Chinese yuan outlook. Then also we'll share with you our third quarter index forecast range. As for the stock picks, we regard EV makers are the rising star in the current market. Okay, so which are the top picks among EV manufacturers in China? Later we'll tell you. And then last presentation, I remember we share with you the China SOE's re-rating and revaluation story. So what has happened to this re-rating and revaluation story? We'll do a follow-up today. And last but not least, we'll share with you our take on the tech stocks on Alibaba, Tencent, Meituan, and Jingdong, JD. Okay. In the first half, the Asia market fared better than the Hong Kong market. Shanghai Composite Index was up 3.65% in the first half, but of course no match to the US market. Nasdaq was up more than 30% in the first half, and the S&P was up around 15%. So Shanghai underperformed, but still up. Shanghai Composite Index was down 0.1% in the first half. So Shenzhen underperformed Shanghai, and Hong Kong underperformed the China Asia market. The Hang Seng Index was down 4.4% in the first half. Sorry, it's the first half. The Hang Seng Tech Index was down 5.3% in the first half. Okay, what are the headwinds the Hong Kong market is currently facing? Quite many. First of all, China's post-COVID economic recovery loses steam and deflation fears are on the rise. I'll share with you later about the CPI, PPI recently announced that raised the deflation risk that China is facing. US on the other hand, US Federal Reserve signals more rate hike to come, at least 2 more rate hikes this year. So the widening yield interest differentials between China and the US render the US dollar more stronger because of growing expectation of further rate hikes that also dampen the Chinese yuan. A weakening China yuan may trigger further capital outflow that is negative to the stock market. And then US-China tension intensifying despite the recent visits by US officials to China, given friction over Taiwan, the South China Sea, and the tech war between the US and China. Besides that, Chinese developers' debt woes continue amid renewed home sales softness and a lack of aggressive stimulus. There are companies that lately default on their debt. Debt default continues to happen among developers in China. And Chinese big tech firms' earnings growth also stalling amid a weakening economy as well as rising competition. Okay. At the start of 2023, China's economy showed a mild but mixed recovery. First quarter economy is doing quite well after the post-COVID opening. First quarter GDP grew 4.5% year-on-year, above expectations. But entering the second quarter, recent recovery has been hit by rising youth unemployment, disappointing retail sales, and industrial production, and also an entrenched property downturn, mounting local government debts, and weakening global demand and deflationary pressures. Infrastructure investment mainly relies on the issuance of new special bonds to maintain a high growth rate, but there may be pressure on this source of funding following the concerted issuance in the first half of the year, if revenues from land sales remain limited in the third quarter. I explain a bit. Infrastructure investment has to be funded by local government. And in the past, local government derived their revenue mainly from land sales. When the property market was hot, local government attained good revenue flow from land sales. But since the downturn of the property market, revenue from land sales decreased, and the local government has to rely more on issuing provincial municipal bonds or special bonds to fund their infrastructure. But now this is also under pressure. Okay. The industrial sector is also under pressure, mainly due to the global economic downturn, which has hampered industrial outputs, exports, as well as insufficient domestic demand. Later, I will share with you the latest trade data coming out from China. Markets now anticipate more policy support to bolster stuttering economic recovery, despite the central bank cutting key lending benchmark rates in June to shore up activity. The People's Bank of China cut lending rates in August last year, and after 10 months, they cut lending rates again in June last month, but only by 10 basis points. So market regarded that the cut is not sufficient to stimulate the economy. And also, so there are reports lately that Beijing is lining up a tranche of measures targeting multiple areas of the economy, particularly the real estate sector. Whether these measures will materialize, they will roll out stimulating policies. We'll watch closely the Politburo meeting, which is scheduled to host around end of July. No fixed date yet, but normally the Politburo meeting will be held every year towards the end of July. Okay. Now let's look at the growth driver of for the economy. The three growth driver, the three GDP growth driver, namely real estate, industrial production, and retail sales. Fixed asset investment. Sorry, the three growth driver is fixed asset investment, retail sales, and industrial production. Fixed asset investment continues to decline. The growth rate declined lowers to 4% in the first 5 months this year. And among industries, investments low for both the primary sector, only 0.1% growth, in the first 5 months versus 0.3% growth in the first 4 months. And the tertiary sector grew 2% in the first 5 months, lower than the 3.1% growth in the first 4 months. Only investment in the secondary sector grew faster at a faster rate of 8.8% versus 8.4% in the first 4 months this year, mainly supported by rises in mining, manufacturing, and utilities. Utilities saw the fastest growth in the secondary sector. And real estate investment remains to be the main drag on fixed asset investment. Real estate investment, as you can see on the right from the chart on the right-hand side, slumped further in May, down by 7.2% in the first 5 months this year, worse than the 6.2% drop in the first 4 months. Amid weak confidence, potential oversupply problems, and challenges facing cash-strapped developers. Okay, property prices accelerated recently, but sales remain slow. Property sales by area. On the chart, from the chart on the left-hand side, you can see that the blue line, the blue curve represents sales, property sales by value. And the yellow line represents property sales by area. So property sales by area fell 0.9%, but property sales by value was up by 8.4%, mainly helped by rising property prices, improved property prices, I would say. But unsold residential space swelled 15.9% to 310 million square meters. That is equivalent to 2.7 million housing units based on China's average residence size of 111.18 square meters. On the right-hand side, the chart shows Market iBox China High Yield Real Estate Bonds Index. Now it's back down to near where it was trading in November. You can see from the chart, it had a short, brief rally in the last 3 months of 2022, and recently it was back down to near where it was trading in November. November last year was the time when Beijing announced support for the sector through a 16-point plan, which is aimed at supporting developers' debts at the project level. That means there's still uncertainty about whether developers can repay investors for bonds, for the bonds they issue at the holding company level. So it only helps. The 16-point plan only enables developers to raise funds to service their debts at the project level. But at a holding company level, the impact is limited. Okay, industrial output rose 3.5% in May, slower than the 5.6% growth in April, and also slightly missing expectations for 3.6% growth. May's expansion marked the slowest growth since February. You can see on the from the chart on the left-hand side, the lowest growth in industrial output this year was the first 2 months, 2.4% growth rate. February is higher. And on the right-hand side, the chart shows industrial profit. Decline in the industrial profit, however, narrowed in May for the 3rd consecutive month. It was still down 18.8%, but much improved from the 22.9% drop at the beginning of the year, thanks to improved profitability in the equipment manufacturing sector. Retail sales growth also missed estimates. Retail sales jumped 12.7% in May, slowing from the 18.4% gain in April and below market expectations for a 13.6% increase. One may wonder One may question 12.7 double-digit growth in retail sales. Is it not a healthy sign? But I would like to point out here that the year-on-year figures were distorted by comparisons with a very weak performance last year, when many cities in China were under stringent COVID lockdown. So this is there's a low base effect. Okay. Exports tumble in May, as you can see in this chart. Both exports and imports declined consistently since 2021. China's exports fell for the first time since the start of the year. The light blue line represents exports, and the dark blue line represents imports. So exports was down 4.5% in May, dropping from 7.5% a year ago. Much larger than the forecast 0.4% drop. Slowing growth is due to slowing global growth, especially in the US and Europe, that weigh on Chinese exports. On the other hand, imports contracted 4.5%, slower than expected 8% decline, and also slightly better than April's 7.9% fall. But most China's imports are raw materials for processing and manufacturing. So as factory output continues to slow, imports contracted at a slower pace, which is not still not a good sign. Okay, I mentioned deflation risk just now. Yesterday, China announced its CPI and PPI data. CPI in June was flat year-on-year, no growth at all, its lowest level since February 2021. PPI fell 5.4%. You can see from the chart on the right-hand side, the blue line represents the PPI, Producer Price Index, falling 5.4% year-on-year, which is the fastest rate of decline since December 2015. Inflation has largely moderated in China following its reopening. The reopening of the economy has not resulted in higher inflation. On the contrary, market are worried about deflation, about the economy heading into deflation, as reflected by the consistent decline in PPI. Okay, PMI Purchasing Manager Index data also points to stuttering growth ahead. Both official and Caixin manufacturing PMI are not doing well. The official manufacturing PMI has been below the break-even 50 level since April. Though the contraction in recent months is relatively stable, yet it's still in contraction. Below 50 level means contraction. The Caixin manufacturing eased to 50.5 in June from 50.9 in May. Although it still remains above 50, it also shows a trend of a declining trend. The Caixin non-manufacturing PMI fell to 53.9 in June from 57.1 in May, which is the second worst reading this year, indicating that the reopening surge in the service sector now is subsiding, and the second half could see weaker support from the service sector. Consumption accounts for a big part of China's economy. So weaker consumption, weaker service consumption points to stuttering growth in the second half. Okay, this year China sets a GDP growth rate at around 5%, which is considered moderate following a low base in 2022. And recently, Premier Li Qiang reiterated that China is on course to achieve its 5% target for economic growth in 2023. We do not expect, although the economy has shown signs of weakening signs recently, we still do not expect policymakers to unleash major stimulus, as the 5% GDP growth rate target is still well within reach, and Premier Li Qiang sounds confident about achieving the 5% target. Yet, policymakers need to adopt a more targeted approach to tackle issues such as property risks and youth unemployment. The jobless rate for the 16 to 24 age group hit the record high of 20.4 in April. In May, it continued to rise to 20.8. So this is definitely one worrying problem for China, high youth unemployment rate. And a weakening yuan and widening yield differentials of the United States will limit the scope for any substantial monetary easing. We expect the PBOC to cut the reserve requirement ratio again in the third quarter and interest rates in the fourth quarter. But because, as I mentioned here, the widening yield differentials between the US and China will limit the scope for rate cuts. The next rate cut will be similar, we expect will be similar to the recent rate cut in June, whereby major key lending rates are cut by only 10 basis points. Okay, that is not sufficient to stimulate the economy. At the moment, we still maintain our 5.4% GDP growth forecast for China this year, assuming that China will roll out new stimulus packages to support the economy very soon, probably before and after the Politburo meeting, end of this month. Okay, the yuan has been on a weakening path over the past 3 months, testing its weak point against the US dollar at 7.3 back in 2022. This is a result of a sluggish recovery in China and widening interest rate differentials with the US. CNY and US dollar interest rate differential based on the difference between China and US 1-year interest rate swap rates currently sits around negative 3.4%. It means China interest rate, 1-year interest rate is 3.4% lower than that of the US dollar interest rate. And with 2 more rate hikes by the Fed and further rate cut by People's Bank of China, this difference is expected to widen further. Okay, but the PBOC is expected to tolerate further weakness in the yuan, and it is allowing market forces to drive the yuan as long as price action does not get too unruly. So you don't see much actual intervention in the forex market to support the yuan. Also, we did not notice the PBOC talking up the yuan. So the PBOC is expected to tolerate further weakness in the yuan. Yuan bears need to watch out for factors that may reverse the yuan's weakening trend. These factors include a stronger Chinese stimulus policy that can regenerate momentum in economic recovery and thus boost capital inflows, and the US interest rate rate hike cycle nearing an end, and China's improving trade surpluses from greater trade between China and global South countries, namely ASEAN. Okay, our forecast range for Chinese yuan, the offshore yuan, in the third quarter is between 7.1 and 7.4. We expect resistance around. We expect support around 7.4 yuan to $1, and resistance around 7.1 yuan to $1. Okay, as for the index, stock market index, our forecast range for Shanghai Composite Index in the third quarter is between 3,100 and 3,400. Currently, it's trading around 3,200. Okay, so there's 200 points upside and 100 points downside. As for the Shenzhen Component Index, we expect our forecast range for the third quarter is between 10,300 and 12,000. Now is around 11,000. Okay, some midway between this forecast range. As for the Hang Seng Index, our forecast range is between 17,500 and 19,800. Okay, recent low was 18,045, seen in end of May. So far, it manages to hold above 18,000. But if more headwinds, the Hang Seng Index may test the 18,000 support, and if it breaches the 18,000 support, the next support level will be 17,500, and resistance level is expected to be around 19,800 to 20,000. As for the Hang Seng Tech Index, it was supported by recent by the strengthening Alibaba, which I'll talk later. Recently, Alibaba share price has strengthened, so you can see that the tech index outperformed the Hang Seng Index in the last 1 month or so. It's still around 10% higher than the recent low, around 3,560 points hit in end of May. Now we expect the range in the third quarter to be between 3,720 and 4,200. Okay, our stock pick this time, the rising stars are the EV makers, but not, let me make it clear, let me clarify, not all the EV makers listed are favored by us, only a few, and I'll tell you our topics later. Let's take an overview of the China passenger electric vehicle market. In 2022, passenger EV sales in China reached almost 5.67 million units, indicating a remarkable 90% growth compared to 2021, and already exceeding its 2025 target of 5 million units. So the development of the EV market in China was very fast, much faster than expected. The 2025 sales target reached in 2022. China EV sales are expected to exceed 8 million units by the end of 2023. So another 40 to 50% growth this year compared to last year. China's passenger EV sales grew 29% year-on-year in the first quarter 2023. So in the first quarter, despite the price war, actually price war helps as EVs become electric vehicles, electric cars become cheaper, there are more buyers. Among passenger EVs, battery EVs, BEVs, made up nearly 70% of the sales. The rest come from plug-in hybrid EV, but in terms of sales increase, the sales surged 88% in the first quarter this year. year on year this first quarter. But the market is very concentrated. The top 10 automotive groups encompassing 28 brands. Some car makers have more than one brand. So the top 10 automotive groups encompassing 28 brands collectively accounted for over 80% of the total passenger EV sales. And the top 10 best-selling models collectively accounted for 46% of China's passenger EV sales. Foreign brands like Volkswagen, BMW, Mercedes-Benz, Hyundai, and Nixon experienced a combined 4 percentage points decrease in market share compared to a year ago in the first quarter this year because of the local car makers gaining more market share in the automotive market in China. At the moment, China homegrown brands, domestic brands, already account for more than 50% of the automotive market in China. It used to be below 40%. It used to be dominated by foreign brands or JVs, foreign JVs, such as Honda and Toyota, BMW, and Volkswagen and GM. But now domestic car makers already accounted for more than 50% of the market. Tesla is an exception, stands out as an exception because their EV sell well in China, partly attributable to the price war. It started. The price war it triggered had an adverse impact on domestic EV startups. So the startups are victimized by the price war started by Tesla. Smart EV brands such as NIO, Xiaopeng, and Neta. Smaller EV makers could be most vulnerable in a prolonged China price war. So we expect the price war to last longer, will not end soon. And smaller EV makers will be most vulnerable. So just now I mentioned, we reckon that EV makers are the rising star in the current stock market, but not all EV makers will benefit, especially the startups, the so-called smart EV brands. They are more vulnerable due to their thinner margins and also dwindling cash reserves. Many of the startups are still losing money. So whether they have the cash reserve, they may have to raise fund to fund their production. Okay. Besides the domestic market, the domestic market will continue to grow. As I mentioned, last year, passenger EV sales reached 5.67 million. Is expected to grow to more than 8 million this year. But there is a bigger market outside China. We see big overseas potential for China's EV markets. And also they feel an increasing urgency to expand overseas as consumer demand weakens amid an economic slowdown, and also Tesla's aggressive price cuts heighten domestic competition. So there is push and pull factors for China's EV makers to expand overseas. In 2022, China's EV exports stood at 679,000 units, up 1.2 times year on year, accounting for more than 10% of total EV sales in China. These data are provided by the China Association of Automobile Manufacturers. The figure is expected to reach 1 million units this year. So around 50% growth rate compared to last year. Chinese car makers are expected to capture around 15% of Europe's EV market by 2025. as players such as, now it's less than 10%, as players such as BYD, NIO, and Li Auto gaining popularity among European consumers. Europe and the US are regarded as the major markets. So EV sales are still low outside the major markets. But 2022 was a growth year for certain emerging markets, namely India, Thailand, and Indonesia. Collectively, sales of electric cars in India, Thailand, and Indonesia more than tripled in 2022 compared to 2021, reaching 80,000 units. Still a small number compared to that of China. For Thailand, the share of EV in total sales came in at slightly over 3% in 2022, while both India and Indonesia averaged around 1.5% last year. So there's a very big, huge potential for expansion in just these three markets, Thailand, India, and Indonesia. There's also another rising market, Middle East, although its EV market is still at a nascent stage, will be expected to offer potential for growth. According to one industry report, demand for EVs in the UAE is projected to grow by an annual rate of 30% between 2022 and 2028. Meanwhile, the increasing level of government-level interactions between China and the Middle East, they are on good terms. This is offering reassurance for automakers to invest in the region. Okay, within China, the Chinese government is expected to continue to roll out supportive policies to boost EV market's growth, because the Chinese government increasingly views EV as a crucial pillar of its economy and the country's green transformation, aligning with its broader goals of reducing carbon emissions, improving air quality, and enhancing energy security. In May 2023, China's Development and Reform Commission released a strategic document aimed at promoting EV adoption in rural areas. Now, the penetration of EV in rural areas is still relatively low compared to the penetration rate in cities. So one way to boost EV market is to raise the EV penetration in rural areas. This will encourage auto manufacturers to introduce more affordable models, EVs that are selling less than 50,000 yuan, and also enhance sales system, make it easier for rural population to buy EV, and also facilitate trade-in services for rural consumers. Okay, one important step China has taken is it has announced to extend its EV tax exemption policy until 2027. Under the extended policy, EV purchase in China between January 1st, 2024 and December 31st, 2025 will be granted an exemption from the purchase tax. Is 100% exemption with a cap of 30,000. Sorry, it should be 30,000. Zero because of typo error. Zero is missed here. So it's with a cap of 30,000 yuan, equivalent to $4,170 per vehicle. In the past, the EV tax exemption policies is renewed every year. So towards the expiry of the tax exemption policy, there's always uncertainty whether the policy will be renewed. But this time round, China announced the policy, the tax exemption policy for the next 4 years up to 2027. So for the next 2 years, 24 and 25, there will be 100% tax exemption for EV purchase with a cap of 30,000 yuan. Starting from January 1st, 2026 until December 31st, 2027, the 2 years between 2026 and 2027, the tax exemption will be halved, 50% exemption, with a cap of 15,000 yuan, signaling a gradual reduction in government support to the EV industry. Okay, one of our top picks among EV makers in China is BYD, BYD 1211. It's the top 3 automotive group in terms of BEV sales market share in the first quarter of 2023. It accounts for 22.4% BEV sales of the BEV market, surpassing Tesla. You can see Tesla ranked number 2 with 13.5% market share. And it secures its leading position with 79% sales growth in the first quarter, and also 9.8 percentage points increase in market share year on year. Okay, it's the top 3 automotive groups in PHEV. So this chart shows you BEV sales and hybrid EV sales in both segment, both BE pure electric vehicle and hybrid electric vehicle. BYD ranked number 1 in the hybrid EV segment. It has a very huge, very high market share, accounting for 68.4% of the market. Okay, these are the BEV model, top 5 BEV models in China, in the best-selling 5 BEV models in China in the first quarter this year. Number 1 is Tesla's Model Y. So BEV, in BEV, Tesla overall sales underperform BYD, but in particular specific model such as Model Y, Tesla wins over BYD. BYD has 2 models ranking among the top 5, namely Yuan Plus, ranking the 2nd place, and also Dolphin, ranking taking up the 4th place. But in hybrid segment, in the hybrid EV segment, BYD is the clear winner. You can see all the top 5 best-selling PHEV models in the first quarter in China were manufactured by BYD. Song, Qin, Tang, and Han, these are the Chinese dynasties. Denza D9 is also a sub-brand under BYD, so it also belongs to BYD. So all the top 5 best-selling PHEV models in the first quarter were manufactured by BYD Auto. Okay, in June this year, BYD sold a record 253,000 vehicles, up from 240 in May and 210,000 units in April. So very stable growth recorded by BYD. And for all of the second quarter, BYD sold more than 700,000 vehicles, up 27.4% versus the first quarter. By comparison, Tesla delivered 466,140 BEVs worldwide in the second quarter, behind BYD's more than 700 vehicles. But Tesla did manage to beat estimates of around 445,000 units. Tesla does not report sales by country, but China accounts for a big chunk of its global sales. And in the first 6 months of 2023, BYD has already sold more than 1.2 million EVs. Last year, BYD sold more than 1.8 million EVs, and this year it has a 2023 target of selling at least 3 million vehicles. To achieve its target, to attain its target, BYD will have to sell roughly 290,000 a month in the second half. So yes, to continue to grow its monthly shipment of cars. And net profit for the first 3 months of 2023 was 4.13 billion yuan, up 410% from a year earlier. On revenue, that's up 79.8% to 120.17 billion yuan. Okay, business outlook remain favorable. BYD has made inroads into various foreign markets, including Southeast Asia, Australia, Europe, Middle East, and Latin America. BYD is building its first overseas plant in Thailand, which boasts the biggest auto market and car manufacturing hub in Southeast Asia. It will also invest $620 million to build an industrial complex in northeastern Brazil, just announced recently. This industrial complex will comprise 3 plants to manufacture chassis for buses and electric trucks, assemble EVs, and produce lithium iron phosphate, key material for EV batteries. This Brazilian project will start operations, is expected to start operations in the second half of 2024. One dampening factor on BYD share price is the disposal by Warren Buffett. So far, Warren Buffett has announced 12 disposals since they started selling down on his stake, on his holding in BYD. Currently, Berkshire Hathaway has reduced its holdings in BYD to 8.98%. So we reckon that the further disposal by Warren Buffett would have diminishing impact, will have a lesser impact on the share price of BYD. Okay, you can see in this chart, BYD outperformed the Hong Kong stock market. Its share price rose to as high as 272.8 last month, and now is in a correction phase. We reckon that the blue line represents a 50-day moving average. It has good support around the 50-day moving average. Currently, the 50-day moving average lies at $247 and $248. So if the share price corrects to around 248, below 250, that would be a good entry point. Near-term target we have for BYD is 270, and the medium-term target is $300. Okay, we have one more stock pick, among the EV makers in China, and there's Li Auto, Lixiang汽车. Stock code is 2015. It delivered 32,575 vehicles in June this year, up from 28,277 in May and 25,681 in April. Also very stable and consistent growth, and the growth rate much faster than BYD, also because of the relatively low base. For all of the second quarter, Li delivered 86,533 vehicles, well above prior guidance for 76,000 to 81,000, and also up from 52,584 deliveries in the first quarter. Now he has already surpassed his total 2022 deliveries in the first half of 2023. He has surpassed his total 2022 deliveries. For the coming third quarter, Li aims for monthly deliveries for the L8 and L9 model. It unlike Leo and Xiaopeng and other smart EV brands, Li Auto has very few models, fewer models. In the past, before the introduction of L8, L9, and L7, is only one model, Li 1, which is selling very well. Now it has introduced more models, L8, L7, L9. So for the third quarter, it aims for monthly deliveries for the L8 and L9 of more than 10,000 each, and hoping to hit 15,000 monthly sales for the L7. So for the fourth quarter this year, is targeting overall monthly deliveries of 40,000 units, from 10,000 to 20,000 to 30,000. Now is aiming higher target, 40,000 in the fourth quarter. And it will also roll out its first all-electric model in the fourth quarter, which is known as the Mega minivan. Okay, financial highlights. Total revenues were 18.79 billion yuan in the first quarter of 2023, representing an increase of 96.5% from 9.56 billion in the first quarter last year, and an increase of 6.4% from 17.65 billion yuan in the fourth quarter of 2022. Net profit was 933.8 million yuan in the first quarter of 2023, compared with 10.9 million net loss in the first quarter of 2022, and representing an increase of 252% from 265 million net income in the fourth quarter of 2022. Free cash flow was 6.7 billion yuan, compared with only 502 million free cash flow in the first quarter of 2022, and representing an increase of 105.8% from 3.26 million free cash flow in the fourth quarter of 2022. Business outlook. In terms of autonomous driving, Li expects to release its city NOA for beta testing in its full-stack self-developed Li AD Max 3.0 in the second quarter this year, and targets to roll out in 100 cities nationwide by the end of 2023. It's also introduced its 800-volt fast charging solution, which allows its BEVs to achieve a driving range of 400 kilometers with around 10 minutes of charging. So the charging time is shortened to 10 minutes. It will also strive to establish a model portfolio of 1 super flagship vehicle, 5 EREVs, and 5 HPC BEVs by 2025. To support charging for its EV, it plans to build over 300 charging stations along highways by the end of 2023, and will strive to expand its charging network to 3,000 charging stations by 2025. So its share price, like BYD, also outperformed the market, rising to close to 150 Hong Kong dollars early this month. This year, it has clearly outperformed the market and also other smart EV brands. Okay, we will recommend to buy around 130 if its share price correct about around 10% from the recent high of 147.6 Hong Kong dollars to around 130 would be a good entry point. Okay, now let me follow up on China SOE's re-rating and revaluation story. Okay, in the decade between 2011 and 2020, SOE stands for state-owned enterprise. In the share market, underperformed significantly in the 10 years between 2011 and 2020, in which POE stands for private-owned enterprise, went up 2.5 times in total return, versus SOE's mere 12%. But you can see from this chart that the tide began to turn in early this year. From January, since last year, early this year, you can see the white line represents the SOE index, whereas the light blue line represents the CSI 300 index. There are more private POEs there, so you can see the outperformance widens in the last 6 months this year between SOEs and POEs in China. This is caused by as I mentioned, SOE began to outperform since the beginning of this decade, from 2021, starting from 2021, with SOEs recording a positive move of 21.6% from the beginning of 2021 till now, whereas private-owned enterprise suffered a great loss of over 50% from the beginning of 2021 till now. This turn in tide was in sync with the implementation of the government's 2022 to 2022 action plan, which aimed to transform SOE into competitive and modern enterprises. Since 2020, the average annual investment growth rate of strategic emerging industries of central SOEs has exceeded 20%. In November last year, Chairman of the the CSRC, China Securities Regulatory Commission, Yi Huimen, stated that China will explore ways to establish a valuation system with Chinese characteristics, which will help improve the current low valuation of state-owned enterprises. Okay, but the SOE rally has run out of steam since we recommend. I remember we recommended 4 stocks last time in my presentation, and in the oil and energy and material sector, I recommended PetroChina 857. In the telco sector, I recommended China Mobile 941, and in the banking sector, I recommend Bank of China 3988, and in the infrastructure sector, I recommend China Railway Construction 1186. So the share price rose rally in the first 5 months this year. So now is under correction phase after the rally in the first 5 months this year. Okay, so year to date, SOEs in most sectors except energy and utilities outperform. The best performer is healthcare SOE in the healthcare sector. It was up 16.1. The share price, those SOE listed on Asia market as well as Hong Kong, were up 16.1%. Followed by communication services up 10.5%, and industrials also up 10.5%. Followed by real estate. You can see a clear distinction between state-owned real estate and private-owned real estate. Private-owned real estate fared very badly so far this year because of debt default concerns, but state-owned real estate property developers are viewed as safer and more solid compared to their POE counterparts. Okay, and IT was up 5.3% year to date. SOEs in IT sector. SOE in consumer discretionary up 4.5%. The 3 underperforming sector are namely materials, utilities, and energy. Okay, I wish to point out SOEs, state-owned enterprises, actually play a vital role in China's economy. It accounts for 30% of China's GDP and 46% in fixed asset investment and 25% of national tax revenue. So SOEs are very vital to China. Out of a total of about 4,800 listed companies in mainland China, there are about 1,300 SOEs, capturing 69% of the market revenue and 77% of the total profits. Okay, the two pie charts here. So SOE captures 69% of total market revenue and 77% of total market profit. Okay, but in terms of number of SOE companies, it accounts for 27% of the 4,800 listed companies in mainland China. Most leading listed companies across key industries, including banks, insurance, brokerage, oil and gas, chemicals, coal, power, telecom, construction, Chinese medicine, and liquor are SOEs. And on the 2022 Fortune Global 500 list, there were 99 Chinese SOEs being included. So Chinese SOEs are increasingly influential on the Fortune Global 500 list. In the first quarter this year, SOEs remained resilient and delivered operating income growth of 6.6% year-on-year, and net earnings growth, even faster net earnings growth of 12.4% growth year-on-year. The Chinese government is pushing a new round of reforms to boost the valuation, to try to boost the valuation of SOEs. So the SASAC, which stands for the State-Owned Assets Supervision and Administration Commission of the State Council, is now pushing a new round of reforms through specific official directives, market consultation documents, and policy announcements. The latest initiatives would focus on encompassing SOE restructuring, strategic positioning, corporate governance, and capital allocation efficiency. SOEs must evolve to meet the changing needs of China, that is, safeguarding the country's economic development, particularly in advanced technology and its national security at a time of rising geopolitical tensions. So SOEs also have their political duty, political task to fulfill. The measures for reform include launching a program for SOEs to be benchmarked against world-class enterprises in terms of value creation, adjusting the performance evaluation system, and further deepening SOE reforms, promoting the high-quality development of central SOEs, encouraging the listing and stabilizing capital markets. The fourth measure is stressing the importance of ROE, return on equity, stability of cash flow, and earnings quality, which may be overlooked in the past by state-owned enterprise. To conclude, we believe China SOEs have strong backing of policy makers to reinvent themselves and unlock values to commensurate their contributions to the real economy. So their re-rating and revaluation journey is far from over. It's the current retreat is a correction, is a normal correction in share price after the rally in the first 5 months this year. So after the correction, we still see further revaluation in future. Okay, I'll take on ATMJ. Okay, Alibaba. This chart is up to last Friday. So yesterday and today, its share price has strengthened because of news about the Ant Group. Okay, the near-term support is $75, and next support is $70. Near-term resistance 88. Yesterday it hit a high around 89, but could not manage to breach the $90 resistance level. And above $90, the next resistance level is $92. First quarter financial highlights. In the first quarter of 2023, revenue was 208 billion yuan, an increase of only 2% year over year. So that explains why Alibaba's share price underperformed the market. Is because of the slowing growth rate. Direct sales and other revenue under China Commerce was 71.78 billion yuan, decreasing by 1%, mainly due to decrease in offline store sales, which was negatively affected by COVID-19 disruption in January this year, and also seasonal volatility from an earlier Chinese New Year, as well as normalizing grocery demand due to decrease in consumer hoarding behavior post-COVID-19. Last year, because of the lockup, people tended to hoard up more consumer goods at home in case they could not leave their homes. But after the reopening, people are buying less, hoarding less. So we witness a normalization of grocery demand. Revenue from Cainiao after inter-segment elimination grew faster, much faster, grew 18% to 13.6 billion yuan, primarily driven by increasing revenue per order from international fulfillment solution services, as well as increasing demand for consumer logistics services. So it is reported that Cainiao may be listed on the Hong Kong EX in the third quarter this year. So they are preparing for listing as early as the third quarter this year. And Hema Xiansheng, another subsidiary under Alibaba that's dealing in fresh food e-commerce, is planning a listing in Hong Kong in the fourth quarter this year. So with stroke of luck, Alibaba may be able to spin off and list 2 subsidiaries in the second half this year. But revenue from the cloud segment, once a growth driver for Alibaba, was very disappointing in the first quarter. It saw a decline of 2% year over year to 18.58 billion yuan. Income from operations was 15.24 billion, a decrease of 9% year over year. Adjusted EBITDA increased, however, by 60% to 25.28 billion yuan, but primarily due to an increase in China Commerce adjusted EBITDA, as well as narrowed adjusted EBITDA losses of local consumer services and digital media and entertainment. Free cash flow was 32.267 billion yuan in the first quarter. The board has approved a full spin-off of the Cloud Intelligence Group via stock dividend distribution to shareholders, but the listing may not happen this year. It may be listed next year, and the spin-off of the Cloud Intelligence Group via stock dividend distribution to shareholders may also reflect that the cloud business, Alibaba's cloud business, is no longer a fast-growing business. So it prefers to distribute it to shareholders as a stock dividend via stock dividend distribution, rather than listing as through an IPO to raise more funds for the company. Okay, business outlook. Slowdown in China's economic recovery, especially in consumption, and there's lack of growth catalysts. US-China geopolitical tensions may weigh on the stock's outlook. Alibaba announced a split into 6 units, which would allow each division to seek out its own financing or even IPO. But under the current sentiment, we remain reserved. We have reservation about the IPO response because market sentiment is still weak and valuations may be lower. Regarding the spin-off of the 6 units, our view is short in the short term is bullish for Alibaba, is positive for Alibaba, but in the long term is negative. It's not so positive because by breaking up splitting into 6 units, the ecosystem it has built, or the synergy, it will weaken the synergy among the units and also the synergy towards the parent company. CSRC imposed a fine of 7.123 billion yuan on Ant Group, just announced last weekend, and required Ant Group to shut down the Xianghubao business that was carried out in violation of regulations and to compensate consumers. Although the fine, 7 billion fine, is bad news to Ant Group, yet it's deemed as good news by the market because the Ant's penalty is interpreted by the market as a move that marked the end to a years-long regulatory overhaul of the fintech company and a key step to concluding a crackdown on the country's internet sector, also paving the way for the fintech firm to secure a financial holding company license and eventually revive its plans for a stock market listing. Okay. Regarding AI development, Alibaba has announced that it will roll out its own artificial intelligence AI ChatGPT style product called 同义全文, which will be integrated across various business segments in the near future. But Alibaba did not give details on its timeline. Okay, Tencent, its share price is quite neutral recently, stuck in a sideways pattern, stuck between $310 and $350. You can see from this chart. The near support is around 310 Hong Kong dollars. Below that, next support is 300. Near-term resistance is around 340, and next resistance is expected around 360 Hong Kong dollars. First quarter financial highlights: revenues increased by 11% year-on-year, at least double-digit growth to 150 billion yuan. Revenues from value-added service business increased by 9% to 79.3 billion yuan, among which international games revenues increased by 25% to 13.2 billion yuan. Revenues from online advertising increased by 17% to 21 billion yuan, driven by the addition of video accounts as a new advertising revenue stream. Growth also driven by growth in advertising activities within its mini programs, 小程序, and the recovery of its mobile and mobile ad network. Revenue from fintech and business services increased by 14% year-on-year to 48.7 billion yuan, primarily driven by the recovery of commercial payment activities due to a consumption rebound in China and increased sales of certain cloud services. So for Tencent, its first quarter financial results benefit from the recovery, the short recovery seen in the first quarter after the reopening in China. You can see that it benefits more compared to Alibaba. Cost of revenues increased by 4% to 81.8 billion yuan. As a percentage of revenues, cost of revenues decreased to 55% for the first quarter of 2023 from 58% for the first quarter of 2022. I think Tencent and other tech companies, they are aware that now revenue growth has slowed down. So to maintain earnings growth, the only way is to control is to cut costs and control the operating costs. So Tencent has done quite a good job in cost management. Okay, but bad for the economy are news that tech companies, including Alibaba and Tencent, are laying off more staff to streamline and to downsize their operation. So in the first quarter, profit attributable to equity holders of the company increased by 10%, double-digit growth to 25.8 billion yuan. Business outlook relatively optimistic as Chinese regulators are granting new game licenses. Very stable every month now. They grant around 80 to 90, between 80 and 90 new game licenses to online game operators. So it signals that Beijing was easing its crackdown on the gaming industry. And Tencent stresses that it would take advantage of every license it has obtained and focus on the quality of games to generate more revenue for the company. We expect stable growth in revenue and faster net profit growth, primarily due to favorable revenue mix, increased revenue contribution from profit growth businesses, and better operating leverage, as well as lasting benefits from cost control measures. Okay, Meituan share price is on a weak note. Its share price once dropped to close to $110 towards the end of May. So the near-term support would be around $110 Hong Kong dollars. Next support below that would be 100 Hong Kong dollars. Near-term resistance is expected to be around 128 Hong Kong dollars, and next resistance level is 137 Hong Kong dollars. First quarter financial results, revenues increased by 26.7% year-on-year to 58.6 billion yuan, and profit was 3.4 billion yuan in the first quarter, turning from loss into profit on a year-over-year basis. Adjusted EBITDA was 6.3 billion yuan, reaching the highest level in the company's history. Its core local commerce segment achieved revenue of 42.9 billion yuan, increased by 25.5% in the first quarter. Operating profit increased by more than 100% to 9.4 billion yuan, with operating margin improving to 22% compared to 13.8% in the same period last year. Revenue from the new initiative segment, including Meituan Select, Meituan Youxuan, and Meituan Grocery, increased by 30.1% to 15.7 billion yuan in the first quarter. Operating loss for the segment decreased by 40.5% to 5 billion yuan, and operating margin improved sequentially to negative 32%. So the new initiative segment are still growing quite rapidly, but still making loss, though the loss are narrowing. Achieve operating cash flow of $8.1 billion in the first quarter, and Meituan is holding cash and cash equivalents of 26.9 billion yuan, and also short-term treasury investments of 84.5 billion yuan as of March 31st, 2023. So one may wonder why share price underperform despite the rapid growth in revenue and profits. It's because investors are concerned about have reservation with its outlook as economic recovery slows down, especially in consumption. And also competition is expected coming from 字节跳动 ByteDance 抖音 which is testing food delivery in China, suggesting it wants a slice of the market, which was worth $66.4 billion in 2022. As competition heats up, Meituan will continue to increase aggressive strategies such as discounts and rebates, which will affect its profit margins. Its revenue is expected to grow by 22% year over year the next 3 years. Meanwhile, the rest of the industry is forecast to expand by 36% per year, which is noticeably more attractive. And its price to sales ratio may fall to levels more in line with the growth outlook. So it's I think the share price underperform is firstly due to world economic slowdown, more intense competition from rivals, as well as revaluation, downward revaluation. Meituan launched to look for new growth driver. Meituan is trying to expand overseas. It has launched the Kita brand meal delivery service in Hong Kong on 19 May this year as its first stop to expand outside mainland China as growth slows at home. But it takes time to prove whether it is a right move, whether it's a blue ocean or red ocean. Okay, JD.com also the share price fares quite badly, unsatisfactory so far this year. Near-term support is expected around 131. Next support level is 122. Near-term resistance level is expected to be around 142. And next resistance level is 155 Hong Kong dollars. First quarter financial highlights, similar picture as we saw in Alibaba. Net revenue only increased by 1.4% from the first quarter of 2022 to 243 billion yuan. Net product revenue decreased by 4.3%, while net service revenue increased faster by 34.5% to 47.4 billion, accounting for about 20% of total revenues. Net income attributable to the company's ordinary shareholders was 6.3 billion yuan compared to a net loss of 3 billion yuan for the same period last year. Operating margin of JD Retail before unallocated items was only 4.6%. Compared to 3.6% for the first quarter of 2022. As of March 31st, 2023, the company's cash and cash equivalents, restricted cash and short-term investments total 203.2 billion yuan, compared to 226.2 billion yuan as of December 31st, 2022. The launching of a 10 billion yuan subsidy campaign in early March this year to compete against rival Pinduoduo signals competition heating up as China's e-commerce market slows down. So the business outlook remain a bit downbeat as the company is facing mounting challenges to its e-commerce business amid competition from Pinduoduo, ByteDance, Douyin, and also Tencent-backed Kuaishou. Slumping demand for big-ticket items like electronics and appliances, which make up half of JD's sales. It may be under pressure to launch more subsidies campaign following the launch of 10 billion yuan subsidy campaign in early March to compete against its rivals. There's also high-ranking official reshuffling. Chief Executive Lei Xu will retire in June due to personal reasons and named Chief Financial Officer Sandy Ran Xu as his replacement. This surprise move, however, will unlikely change operations in the company. So this ends my presentation today. Now it's Q&A time. I would answer some of the questions from the audience. Recently, AI stocks in the US have gone through the roof, but Chinese AI stocks remain deeply underwater. Baidu, SenseTime, and King. Here. And Kingsoft are 50 to 80% below the highs achieved last year. What is your my outlook for them? Are they attractive level to accumulate? Okay, as most AI companies are still not profitable, making profit in China, so I think the share price will only see momentarily rally. I mean, not the kind of sustainable rally seen in the AI stocks in the US. This Kingsoft Cloud actually had a rebound recently in late June, but the rebound is quite short-lived. So the rally would be relatively short-lived. Of course, there are still China is still developing its AI industry, and there will be we expect more supportive policies to boost the development of the AI industry. But the US-China tension may work not in the favor of AI stocks in China, as it may affect the supply of AI chips to those AI operators. So this is one risk factor to watch out. Okay, what with market participants expecting China crackdown on fintech stocks coming to an end? How do you see the valuation of China tech stock currently? Yes, I agree that I concur that the crackdown is nearing an end, as signaled by the fine levied on not only Alibaba's Ant Group but also on Tencent's Zhifubao, the payment company. But that does not mean we'll see a sharp drastic revaluation among the tech companies, because now they are entering another phase of slowing growth. During the high growth period, they come across this headwind of policy crackdowns, policy headwinds. But now, when the headwinds is over, now they are entering a low growth phase. So low growth phase means low valuation. Currently, Alibaba is trading on less than 20 times PE, price to earnings ratio, and Tencent is between 20 and 30. This is much lower than the 50, 60, or even up to 70 times PE seen in the past, because at the high growth phase has come to an end. Now they're entering low growth phase. But there are still high tech companies in China that remain in the high growth phase. I reckon a few NetEase, Baidu. Baidu will benefit from auto driving, as well as ChatGPT. So these two companies, I will reckon that they will remain in their high growth phase and would enjoy higher valuation. So among the 7 stocks, just now I have shared with you our take on ATMJ, but our current top pick in the high tech sector now are not these 4 companies. Instead, we favor Baidu and NetEase, these 2 high tech companies. What do you think the recent downgrade by Goldman of Chinese, particularly agricultural Bank of China? Yes, Goldman Sachs has issued a research report with the title "Testing the Impossible Trinity." Trinity refers to dividend, share dividend, reserve, and provision. So I think the logic is with China's economy slowing down. There's the worry that Chinese banks they will see deterioration in their asset quality, so they may need to make more provisions going forward, and also they may need to strengthen their capital reserve requirement ratio, the equity ratio, that will cause them to pay less dividend to shareholders. I think I agree with the logic, but what is unknown yet is the extent of the the extent that the Chinese economy will weaken, will cause the impact on Chinese banks. If it's a mild downturn, and if the Chinese government manages to roll out effective stimulus policies to support the economy, then this would not, this pressure, this challenge on Chinese banks on the equity ratio side, as well as the provision, bad debt provision side, will not be that. The challenge will not be a big challenge, so that may not ultimately affect very much the dividend payout yet. So it remains to one has to watch out to remain cautious. But share price reacted very strongly, I would say. From a valuation perspective, at current price level, I think China state-owned banks are still attractive. And among the 5 state-owned banks, namely China Construction Bank, ICBC, Agricultural Bank, Bank of China, and BOCOM, Bank of Communication. Our first two topics are China, Bank of China, and Agricultural Bank. We downgraded ICBC due to its negative growth in revenue in the first quarter. All 4 state-owned banks recorded positive revenue growth in the first quarter, except ICBC. ICBC's revenue declined by around 3% in the first quarter. We favored Bank of China also because its revenue increased the most in the first quarter among the 5 state-owned banks in China. Its revenue in the first quarter increased by 11.5% in the first quarter. Okay. Weakening CNY may trigger outflow. I think it's easy to understand when foreign investor holding renminbi, holding Chinese yuan, if yuan depreciate, or they invest in yuan assets as well. If they invest in yuan assets, when yuan depreciate against the US dollar, so for foreign investors, they have to consider, they have to be mindful that once they convert their yuan back into US dollar, they may suffer currency loss because of a weakening yuan. So that may trigger outflow. They may induce them to dispose of that the yuan assets, namely property and shares, to evade the further depreciation of the yen, which will undermine the investment in yuan assets. Okay. Is there an ETF for SOE? Yes, there is. But but now I don't remember the ticker. Maybe I will tell my colleague in Singapore the stock code, the ticker for SOE ETF listed in Hong Kong. When will real estate woes end and how to see? We expect a prolonged the woes to be extended, and it will not end soon because the intention or the confidence in home purchase is still low in China recently. A lot of the Chinese people, they are repaying their mortgage instead of buying additional properties because of the lack of confidence in the property market. So this will impact the property developers' financial situation, and we may expect more debt default to come in future among private real property developers. If you consider property developer plays are relatively cheap at the moment, we will recommend investors to avoid the private owned property developers, and may as well focus on state-owned private property developers, namely China Overseas 688, China Resource Property 1109, as well as Guangzhou Investment 123. Okay, what's my view about Alibaba? I think I have a very detailed explanation on the outlook of Alibaba just now. Baidu also, we like Baidu, we favor Baidu, and we think it will still enjoy two key growth driver, namely auto driving as well as AI and ChatGPT. Can you share what three main SOE real estate stocks? Just as I already mentioned the three main SOE real estate stocks, namely China Overseas 688, China Resource Property 1109, and Guangzhou Investment 123. Okay, comment on Ping An, why share price not moving? Because first of all, I think it's attributable to the weakening economy, and secondly, China is cutting interest rate. So in a low interest rate regime, and also the stock market is not doing well, it will adversely affect the investment return for insurance companies. So Ping An will be no exception. And also its exposure to its investment in some private owned property developers in China also dampen its share price, namely its investment in Huaxia Xingfu. Okay, do you have any view on Geely, Ganfeng Lithium, and Tianqi Lithium? Okay, Geely is not our, honestly speaking, is not our topic because in terms of car delivery and profitability, it lags behind. It lags behind BYD and Li Auto, and the EV market, as I mentioned earlier, is getting more and more the competitive. With on the one hand, you have Tesla gaining more market share from domestic brands, and on the other hand, competition from smart brands such as NIO, Xiaopeng, and Li Auto. So Geely, we are not very upbeat about its outlook. The two lithium companies, the outlook will hinge on the price of the lithium price, which has surged to because of supply and demand, demand outstripping demand outstripping supply. So early and late last year, lithium price rose to close to 600,000 yen per ton. Since then, because of increase in supply, normalization in supply, lithium price has dropped by more than 50%, 60% from close to 600,000 yuan per ton to below 300,000 yuan. Now it has stabilized a bit, rebounded to around 300,000 yuan, still 50% below its peak. So Ganfeng and Tianqi, they are more involved in the upstream, that is the mining exploration of lithium. So when lithium price surge, they benefit, they are a winner. But when lithium price tumble, they suffer. So in the near term, we don't expect lithium price to see the kind of rally we saw last year. So it may only, worse still, it may be just a technical rebound after being oversold. So it may further decline after the recent rebound. So that will not be favorable to Ganfeng and Tianqi. Okay, do you think Neil and Xiaopeng will survive the price war with Tesla, given that there's still export market that they could expand into, and the pro-EV policy within China itself? I have investment in all these three names. Neil and Xiaopeng will be in a less less competitive position if you compare with BYD and Li Auto. Their EV shipment are also quite unstable. New before June, June is the monthly statement rose to above 10,000, but before that it has dropped to between 6,000 and 8,000. Xiaopeng is even more volatile. The monthly shipment has once dropped to below 5,000, and in June it has rebounded to 8,000, but still below 10,000. To me, I think any EV makers whose monthly statement below 20,000 or 30,000 will not will find it very difficult to survive the price war, because you don't have the economy of scale to compete. Okay, out of all banks, in your view, which is good to invest? As I have mentioned, our topic among Chinese banks is Bank of China 3988. Okay. Many big manufacturing came out of China since few years back. How will the manufacturing landscape be in the future, and how to see the next uprise? Yeah, I think because of the US-China tension, and also the rising cost of operation in China, a few years ago, and also the appreciation of the yuan a few years ago. All these factors, combined factors, cause big manufacturers to move their manufacturing bases out of China into other places such as ASEAN, Vietnam, Cambodia, where low labor costs are cheaper, land costs are cheaper, and also maybe more friendly government policy, as well as conducive quota arrangement by Europe and the US. So I think this trend will continue, and it will become increasingly, but silver lining is labor costs will and also land costs may come down over time because of less demand for labor and land, and that will cause operating costs to come down and render manufacturing in China to be competitive again. I would say at a time when labor costs, land costs all went up, China manufacturing in China, manufacturing made in China or made by China is no longer competitive. But over time, it may be more competitive. May not be as competitive as 10 to 20 years ago, but at least it may be more competitive compared to 5 years ago as labor costs and land costs come down. What do you think about Haidilao? Very competitive market. The hot pot food F&B market in China, and also their strategies is quite swinging. I noticed swinging business strategy. At one time they expanded very rapidly, and then when facing the economic downturn, they revert trend and closed down many of their restaurants. Now they are on an expansion phase again. So this expansion contraction will hinder the growth, the long-term growth of the company. You see the kind of unstable and volatile, fluctuating performance. Among the F&B stocks listed in Hong Kong, our best pick is Yum Brands China, which is more stable in restaurant expansion as well as execution and corporate governance, all better than their Chinese counterparts. 9987, stock code 9987, 百胜中国, Yum Brands China. Okay. Okay, so now it's approaching 1:45. So I think I've answered quite many questions as time is running out. So I will end my presentation here. Hope you find it helpful to your investment in Hong Kong as well as Asia market. Thanks.